Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Altria's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 73 billion market cap. They're trading at $41 a share and they have 1.8 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They're real consistent, 8.2 billion in 2020, 8.5 billion in the trailing 12 months. Lots of free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's a little more volatile. That drops from 4.5 billion to 2.5 billion. Then it jumps up in 2022 to 5.8 billion. Then it balloons to 8.8 billion in the trailing 12 months. We'll look at their income statement later to get a little more detail on this. Revenue is the sales for the company, and that doesn't look so great. Although it's consistent, around $21 billion a year, investors like to see increasing revenue, not flat revenue. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 124 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $112 billion. We divide that by 1.8 billion shares. We get a calculated stock price of $63. They're trading at $41, so they're trading at a 34% discount. It's a pretty strong buy according to the model. This stock has not done well the past few years. It used to be much higher. And I think the reason is less and less people are smoking, especially in the US. They lost a lot of money with Juul and their revenue is flat. But they pay a great dividend. There are 12 companies in the same industry as Altria, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $200 million in CapEx. Philip Morris spends the most at $1.4 billion. We can't look at their debt to equity ratio. They have negative equity. That means their liabilities are higher than their assets. They pay an amazing dividend, 9.2%. BTI pays the most at 9.6%. When you invest in a tobacco company, you generally get a great dividend. And the reason the dividend is so high is because the stock price is usually suppressed lower. Because tobacco stocks tend to trade at a pretty nice discount. They generate lots of free cash flow. BTI is number 1 at 12.6 billion. They rank second in market cap, second to Philip Morris. We can't look at their price to book because they have negative equity. And equity is the bottom of the equation, the denominator. They have a great PE, 8.4. Investors are paying $8.40 for $1 of earnings. Much better than median. A good price to free cash flow, 8.7. It's a little better than the median. This means investors are paying $8.70 for $1 free cash flow. Price of sales is a little higher than the average of median. Price of sales is stock price, that's the P, price, over sales per share. They generate 21 billion of revenue. PM is number 1 at 57 billion. And they're detracting. Their 5-year annual revenue growth rate is negative 1%. 22nd Century Group has a 27% revenue growth rate. I've never heard of that company. 3 million market cap. Marlboro, they spell it wrong on this chart, how ridiculous, is the most popular cigarette in the world. This chart is a few years old, but they're still the biggest currently. In 2017, they sold 365 billion cigarettes, more than double second place, Winston. For a long time, Marlboro sold more cigarettes than every other cigarette brand combined. They were about half or a little more than half the market. Here's some highlights I put together on the company. We talked about number 1. Altria owns Philip Morris. Philip Morris actually makes Marlboro. Altria and Philip Morris used to be the same company, but they split up in 2008, so they're separate entities. PM makes a lot of products. Benson & Hedges, Parliament, Virginia Slims, etc. Cigarettes get a really bad rap, especially in the US. At the peak of cigarette smoking, that was 1954. Just in the US, 45% of Americans said they smoked at least once a week. Now it's 12%. But outside the US, cigarette smoking is still popular. If you travel, you probably know what I mean. 22% of the world uses some tobacco products, and it's a majority men. 37% of the men in the world use tobacco, 8% of the women. And since cigarette sales are declining, they have ventured into other things like e-cigs, cannabis, but they did lose a lot of money from Juul, the vaping company, mainly because the US banned flavored tobacco. Altria invested a lot in Juul, but they had to exit that investment at a pretty big loss. And the main difference between Altria and PM is Altria is present only in the US, where Philip Morris sells its products outside the US. Since tobacco is much more popular outside the US, that's why this company's stock price, Altria, is down 17% in the past 5 years, while PM is up 40%. If you put $10,000 into each company 5 years ago, at one point with PM, you would have been up 70%. With your Altria investment, you would have never been up more than 20%. But you do get a bigger dividend with Altria. Let's take a look at their 10Q from 9/30. In the third quarter of 2023, revenue of $6.3 billion. That's down from $6.6 billion. Here's a breakdown of the $6.3 billion. $5.6 billion is smokable products, $700 million oral tobacco products. Their smokable products include Marlboro, which is a huge bulk of their revenue. These numbers are volume shipped, so they shipped 17.4 billion cigarettes in the third quarter of 2023. Then there's other premium cigarette products, discount cigarettes, and then you have cigars, 451 million. So they shipped 20 billion smokable units, down from 23 billion last year. This table shows their volume in oral tobacco products. Their biggest is Copenhagen, the dipping tobacco, 109 million units in the third quarter. Skoal, 40 million, On, 29 million, and all other 16 million. Copenhagen and Skoal are down. On is up 37%. Overall, they're down 3% in this category, comparing 3Q 2023 to 3Q 2022. All the expenses directly tied to making the products, the manufacturing part, is 1.6 billion. Excise taxes is 1 billion. If you sell certain products like cigarettes, tobacco, gasoline, alcohol, you have to pay an extra tax. They call that an excise tax. It's just another way for the government to gouge Americans. But they have a really healthy gross profit, well above 50%, 3.7 billion. Because half their revenue is around 3.1 billion, and 3.7 is higher than 3.1, so it's above 50%. Marketing 600 million, operating income 3.1 billion. Their net profit is 2.2 billion. Last year it was 200 million. The reason it was so much lower last year was this big write-down of 2.5 billion. That's from Anheuser-Busch. This chart shows their losses from their investments. 2.4 billion in Anheuser-Busch, 100 million in Juul. For the trailing 9 months, it was 1.4 billion in Juul. But for just the third quarter of 2022, it's 100 million. I don't think they could have any more losses in Juul going forward. They didn't have any in the third quarter of 2023. So their EPS, earnings per share, is a lot higher, $1.22 in the third quarter of 2023. Only 12 cents in the third quarter of 2022. Let's look at their balance sheet. This is 9/30/2023, this column. This column is 12/31/2022. So their current assets of 3.4 billion, current liabilities of 10.4 billion. That's a really low current ratio. They're going to need a lot more debt to get through the next 12 months. But I wouldn't be too concerned. This company is a cash cow. They have so much cash coming in. They can easily cover their current liabilities. And if they needed to add some debt, they can. A smaller company may not be able to take on as much debt as a company like this. Plenty of banks and investors are willing to lend to them. Their cash has gone down. It was 4 billion, now it's 1.5 billion. Here's a breakdown of their inventory. 600 million of leaf tobacco, 200 million of raw materials, 300 million of finished product, 1.2 billion of inventory. Lots of PP&E, 4.5 billion. The depreciation is 2.9 billion. So the book value, the carrying value, is 1.6 billion. Goodwill, 6.8 billion. Goodwill is from acquisitions. Other intangibles are 14 billion. They do lots of acquisitions. 10 billion of investments in other companies. 36 billion of assets, similar to last year. 40 billion of liabilities, a little lower than last year. Their biggest liability is long-term debt of $24 billion. And you can see their assets, $36 billion, is lower than their liabilities of $39.8 billion. That gives them negative equity. Their equity is negative $3.4 billion. A big reason they have negative equity is because they buy back so much of their stock. They repurchase $39 billion of their own stock. When a company does that, it brings down their equity. It also brings down their cash. If they didn't buy back all this stock, they would have positive $35 billion of equity. Because you can see they're a really profitable business. Their retained earnings are $31 billion. Retained earnings is a sum of all their prior net incomes minus the sum of all the dividends they paid. It's how profitable the company is historically. Let's take a look at their statement of cash flows. This is for the trailing 9 months. And ironically, their earnings, their net income is almost identical to operating cash flow. Usually operating cash flow is higher. Like last year, you can see their operating cash flow is $5.6 billion. Their net income was $3 billion. In their investing section, we can see how much they invested in property, plant, and equipment, $140 million. We can also see all the companies they bought or sold. They received $1.7 billion from the sale of IQOS system, and they paid $2.8 billion for the acquisition of Enjoy. Enjoy is one of the largest companies in e-cigs and vaping. So this was a great acquisition. Hopefully they don't get fleeced like in Juul. The financing section on the statement of cash flows shows the dividends they paid. It also shows debt they added or paid and equity they added or paid. So they received $2 billion from short-term debt. They paid $2 billion of short-term debt. They paid $1.6 billion of long-term debt. They bought back $730 million of their own stock, which is a small number because last year was $1.5 billion. And they paid out $5 billion of dividends, similar to last year. Here's the company's stock price the last 40 years. You can see from 1982 up through 2017, the stock had a steady incline. It had a huge bull run from 2009 to 2017. But even in the 90s and early 2000s, it pretty much only went up. There were dips here and there, but it rebounded. It got close to $80 a share, but since then, it's really struggled. It almost got down to $30 at the peak of COVID in March 2020. You can see all this red. These are candlestick charts. So when you see red, that means it went down for the month. If you see green, it went up for the month. But right in this box, it's mostly red. It's really been struggling because they're selling less units because less people are smoking, but the price of cigarettes is increasing. So they're raising prices to maintain their revenue, but you can't raise prices forever. They really need to expand the number of products they're selling. If the US does approve marijuana on a federal level, this stock will skyrocket, along with other tobacco stocks. But I don't think that's going to happen. They're really relying on one product, Marlboro. They do get sales from other products, but Marlboro is their bulk, which has been declining. But if you like this stock, it could be a good entry point because it's a lot lower. It's about 50% of its peak. But it may be trading sideways for another decade or two. It's really hard to tell. But they pay an amazing dividend, so it's not like you're totally losing out if the stock was flat. But if the stock goes down another 20, 30, 40%, then you are losing out. And you could see on the bottom is the trading volume. Look how much activity there was before 2010. These bars are so much higher than they are the past 10 years. So it's a lot less trading volume. It looks like their biggest month in trading volume was 1.7 billion shares traded in October 1987. Last month, December 2023, 200 million shares. A lot less activity. And you can see analysts are downgrading the stock. There's a downgrade in 2022, another downgrade in 2022, an upgrade in 2022, then 3 more downgrades. Here's their revenue since 2016. 19 billion, 19 billion, 19 billion, and then around 20 billion the next few years. Their EPS was highest in 2017, 520. 2022, it's 320. EBITDA is increasing. That's a good sign. It went from 9.3 billion to 12.3 billion. So they're doing a good job at lowering expenses. But you can see their market cap has really struggled. It was cut in half from 2016 to 2022. It jumped about 20% from 2019 to 2020, declined about 7% into 2021, then down another 10% into 2022. Here's the shares outstanding since 2016, so they do decrease it each year. It was flat from 2019 to 2020, but they kept decreasing it after that. Let's take a look at the stock on Simply Wall Street. Its last price, 41, 73 billion market cap, up 3% in the past week, down 11% in the past year. Let's see what they say about the company. Altria, through its subsidiaries, manufactures and sells smokable and oral tobacco products in the U.S. They're only U.S. Philip Morris is international. They provide cigarettes mainly under the Marlboro brand, cigars and pipe tobacco under the Black & Mild brand, moist, smokeless tobacco products, and snus. Somebody from Sweden corrected me. Last video I said snus, and he said it's snus. The word originated in Sweden, so thank you for that. Under the Copenhagen, Skoal, Red Seal, and Husky brands, as well as on oral nicotine pouches. They sell products to wholesalers, distributors, and large retail organizations such as chain stores. They were founded in 1822, over 200 years ago, headquartered in Richmond, Virginia. Simply Wall Street's price is $70. They say the stock is 41% undervalued. 16 analysts priced this stock at $47. They say it's slightly undervalued. Here's their revenue since 2013. It was $17 billion, and then it slowly increased over the years, peaking at $23 billion for the 12 months ending March 30th, 2021. But it dropped since then, back down to $21 billion. And the forecast is for the revenue to be flat over the next few years. By 2026, still $21 billion. Their debt in 2013 was $14 billion. Same thing in 2018, $14 billion. Then they added a lot of debt. That was for their acquisition of Juul, up to $29 billion. And their debt has been pretty steady after that. It's currently $25 billion. And their equity is down in the dumps. It was positive until 2021. Then it became negative. And it's been negative since then. And this green line is their cash. They don't keep much cash on their balance sheet. It's currently $1.5 billion. This blue line is their dividend yield. Their yield was only 3 or 4% in 2014, 15, 16, and 17. Then it jumped up to 9% in 2020. Now it's getting close to 10% because the stock keeps dropping. Yet they raised their dividend. The vertical lines is how much dividend they paid that quarter. 48 cents in the first quarter of 2014. And I think they raise it each year. It's up to 98 cents a share. Billy Gifford's salary is $1.3 million. Total compensation $16 million. His tenure as CEO is almost 4 years. Not much insider activity, only 2 buys, pretty small, 2,300 shares total. 59% of the company is held by institutions and 41% by the general public. Their biggest shareholder is Vanguard at 9%, then BlackRock at 7%. Then you can see a lot of big companies own this stock. Morgan Stanley 0.57%, Invesco 0.5%, Eaton Vance also 0.5%, Goldman 0.4%. Their employee count has gone down over the years. It was 9,000 in 2013. At the end of 2022, it's 6,300. That's probably why their EBITDA is improving, lower expenses. And the ticker trades in lots of places: the New York Stock Exchange, London Stock Exchange, Mexican Bolsa, Swiss, Deutsche Börse, Zicha, Santiago, Wiener Börse, EuroTLX, Bulgaria, Santiago, BATS Europe, Buenos Aires, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.